This is Mark Sobel. I'm the U.S. Chair of OMFIF. Today, I have the great pleasure of welcoming Bill Dudley. Bill was Chief Economist at Goldman Sachs for a decade before joining the New York Fed in 2007 as head of the Markets Group, which, as you all know, conducts U.S. open market operations. In 2009, with Tim Geithner's ascendance to the Treasury throne, Bill became president of the New York Fed, where he served till 2018. He's now affiliated with Princeton University. And of course, he's such a towering figure in the history of US monetary policy, he probably needs no introduction. Welcome, Bill. Thanks for joining us today.
Thank you, Mark. So what I thought I'd do is just open up with a few...
Can I just say one thing? So you're going to give a presentation for about 10 or 15 minutes.
Yep.
I'm going to follow up with some questions. I've asked a colleague in Singapore, Tamer Baig, to offer a comment and question at the beginning. Afterwards, and there's a chat function that all of you have at your disposal, and you could submit questions and we'll feed those to Bill the best we can when we engage the audience. My apologies for the interruption. Bill, the floor is yours.
Okay, thank you. So I'm going to talk briefly about the economic outlook and then talk a little bit about the Fed, what the Fed's accomplished, and what lies ahead. In terms of the economic outlook, it's pretty obvious we're going to see a bounce in economic activity in the third quarter. There has been considerable opening up in the United States, and people are less stringent in terms of the degree of social distancing. But how high and how long this bounce will last, I think, is highly uncertain. And anybody who tells you that they understand what the nature of the U.S. economic trajectory, I think, is not telling the truth. A lot of uncertainty about, first, the course of the pandemic itself. That depends a little bit on how people behave. It also depends on whether a vaccine can be developed in a timely way. There's also a lot of uncertainty about fiscal policy. If you look at the three major pieces of fiscal policy support to date, the Paycheck Protection Program, the large increase in unemployment compensation benefits, and the checks that were sent to households, all those three major pieces of fiscal policy are either one time or they end at the end of July. So there's a big fiscal cliff that's happening at the end of July. So if fiscal policy is not forthcoming over the next couple of months, new fiscal policy, that's going to be a pretty damaging blow to the U.S. economy. Also on the fiscal policy side, there's some sizable gaps. While there was a lot of support to households and businesses, the support to state and local governments was very, very modest. And state and local governments in the United States have to run balanced budgets. And so the shortfall in revenue is going to start to lead to stringency in budgets and job layoffs. So you're going to actually start to see the state and local government sector start to be a constraint on economic activity. Second reason why I think there's a lot of uncertainty about the economic outlook is this just slowdown that we've had has been quite sizable. Real GDP in the second quarter, which we'll get at the end of July, is probably going to show an annualized rate of decline of 40, 50, 60%, something on that order of magnitude. And that is causing significant damages to business and household balance sheets. Now, the fiscal policy stimulus we can repair some of that, but not all of that. If you look at the Fed's summary of economic projections, I think their forecast provides, I think, a reasonable benchmark of what might happen. They see an economic recovery taking place in the second half of 2020 into 2021, but the unemployment rate still stays very high for quite a long time. So at the end, the fourth quarter of this year, the Fed's central tendency projection is an unemployment rate of still 9 to 10%. And the unemployment rate doesn't get down to full employment in the time frame of their projections, which extend out through to 2022. So what does this all mean for the Fed? Well, the first is we know that policy is going to stay extraordinarily accommodative for the foreseeable futures. Short-term rates will stay near zero. The large-scale asset purchases that the Fed embarked on are going to continue. They're buying $85 billion of treasuries every month and $40 billion of agency mortgage-backed securities every month. So the balance sheet is going to be growing quite rapidly. In the last couple of weeks, the balance sheet's actually fallen, but it's all just because of the runoff of the foreign exchange swap programs. You remember the foreign exchange swap auctions were 84-day auctions. The first 84-day auctions expired 2 weeks ago. The last week, the second one. So because market function in the foreign exchange markets has recovered, those foreign exchange swaps outstanding are coming down very, very sharply now. And that temporarily is causing the balance sheet to shrink. But that's a very modest, that's not going to last for very long. And that's very modest relative to what the Fed's doing in terms of their asset purchase programs. Also, the liquidity support programs that the Fed has announced for the corporate sector, the municipal sector, to support medium-sized business through the Main Street Lending Program, those are all just starting to get geared up. So I think it's pretty obvious that you'll see a pretty significant expansion of the balance sheet as we get from here to the end of the year. Balance sheet today is about $7 trillion for the Fed, up about $3 trillion so far. And we'll probably get to $9 trillion or so by the end of the year, depending on how fast the Fed can actually ramp up these special liquidity facilities. Fed's also going to be considering other steps. And so let me go through those steps from most likely to least likely. The first thing that they're thinking very hard about is forward guidance. So forward guidance is basically telling the markets how long the Fed expects to keep short-term interest rates low. So far, they haven't rushed into providing significant forward guidance because they're uncertain about the economic outlook and because market expectations are pretty well aligned with the Federal Reserve. You look at the Eurodollar's futures market and you look out 5 years, Eurodollar future yields are still below 1%. So the market is basically saying, we don't think the Fed's going to raise rates for a long time. The Fed in the summary of economic projections is saying we don't expect to raise rates for a long time. So there's no disconnect between the market expectations and the Fed. So that means that forward guidance, there's no rush to do that. And I think the uncertainty about the outlook is causing the Fed to slow down a little bit in announcing its forward guidance, because I think it basically wants to have a more stronger view about how things are likely to unfold. I would guess that forward guidance will be forthcoming at some point, and the Fed will probably tie that forward guidance to economic conditions. So I can imagine forward guidance that looks sort of like this. We're not going to tighten monetary policy until the unemployment rate falls below 5% and inflation climbs above 2%. I mean, obviously, they could pick slightly different numbers than that, but something on that order of magnitude. And that would cause people to say, well, gee, it's going to be a very long time before we get unemployment below 5% and inflation below 2%. And so that would anchor short-term rate expectations. Second thing the Fed's been talking a lot about is yield curve control. So that's the idea of pegging medium-term and longer-term Treasury yields at a particular level, sort of like what's happened in the Bank of Japan. But the Fed has been quite cautious about proceeding here, because while they understand how yield curve control can be implemented, it's pretty easy to implement it. They're concerned about how you actually exit. So I think that it's very unlikely that the Fed will embark in yield curve control beyond 2 or 3 years. I can imagine a situation where the Fed could basically say, for all Treasury obligations out till June of 2023, we're going to keep those yields below, 40 basis points. And they might do that because that would reinforce forward guidance. That would basically make it clear that the Fed does actually expect to keep rates low for 3 years. The advantage of doing yield curve control would also reduce the need to actually buy assets. If you have a credibility on yield curve control, you actually don't really have to buy as many assets, because the market basically knows you're there to buy them if yields start to drift up. So I think yield curve control is possible, but it's not going to be pegging the 10-year Treasury note or going further out the yield curve. It's probably 2 to 3 years out, and just to reinforce the Fed's forward guidance. Third thing that people ask a lot about is, will the Fed move to negative short-term rates? Not going to happen in the United States. The number of reasons why the Fed is not going to pursue that. First, there's not much room created by going to negative short-term rates, because you can only go maybe 75 basis points negative before people start to hoard cash. Second, they don't want to move to negative rates because that will destroy the functioning of U.S. money markets, which have some value. Third, negative rates harm bank profitability by constraining the net interest margin, and that is important because that can potentially hurt credit availability. And the fact that the Fed has been so negative on negative interest rates also makes it more unlikely that they'll ever go there, because it's hard to sell a movement of to negative interest rates as a positive development if you've told people that you're very reluctant to do that. whenever the Fed embarks in a new policy, they always want people to feel that this new policy that we're doing should make you feel more optimistic about the outlook. Well, if the Fed tomorrow said we're moving to negative interest rates, I think the markets would actually react quite negatively, because they'd say, gee, boy, the Fed must be really worried about the economic outlook. So negative interest rates in the United States, at least, I just don't think are going to happen. So what are some of the Fed's challenges? Well, I think the Fed has a lot of challenges. A lot of them are about communication. The first challenge the Fed has is that while monetary policy can do a lot of things, the Fed is not as powerful as people think. So there's room for disappointment. The Fed can take steps to improve market function. The Fed can take steps to make financial conditions more accommodative, but the Fed cannot repair balance sheets that are damaged by weak economic activity, and they can't fill the income hole created by the shortfall of economic activity. And I think it's important for the Fed to be clear about what they can do and what they can't do. Otherwise, there's going to be room for disappointment. The second thing is the problem Fed challenge has is that what they're doing to support financial markets has boosted financial asset prices, and that exacerbates inequality. And that's particularly germane in the current environment, where the coronavirus really disproportionately hurts less advantaged people in terms of their exposure to the pandemic, to their effects on their income, and the Fed's actions by supporting the stock market and supporting the high yield debt market, that exacerbates inequality. And that creates a challenge for the Fed to explain that they're doing this not because they're trying to create greater inequality. They're doing this to basically ease financial conditions to support the economy as best they can. And the third challenge the Fed has is that they're coming to the rescue and bailing out people who you could arguably say had engaged in bad behavior. So you think about the hedge funds that bought lots of cash treasuries and shorted treasury futures, highly leveraged. They got caught in the market in March. The Fed came in and bought lots of treasuries and essentially bailed them out. The Fed's also bailing out people in the high yield debt market by supporting high yield debt. And so that kind of behavior creates this sort of notion that the Fed is there for Wall Street, but not so much for Main Street. So I think the Fed does have some significant challenges in terms of explaining, why it's doing what it's doing, explaining why its tools are limited and there's only so much it can do, and that life's about alternatives. If the choice was no recovery and greater equality, or recovery and greater inequality, the Fed is likely to pick recovery and greater inequality, because generating an economic recovery does benefit the country broadly. So let me close and turn it back to Mark.
Well, thank you for that wonderful presentation. I guess one question I have is, you basically suggested that, as is known, monetary policy is less effective around the zero bound, and you've gone through a range of options, and you've suggested that they can be of limited impact. So even though monetary policy is your specialty, what can you tell us about how you think about the fiscal monetary mix going forward?
Well, right now, I don't think there's a conflict between the goals of the fiscal authorities and the goals of the monetary policy authorities, because the economy is so far below full employment and we're in a disinflationary environment. So both sides want to see an economy that grows faster and see a decline in unemployment. But one can imagine a conflict that could develop a few years down the road, if the economy actually gets back towards full employment and the Fed wants to start to raise interest rates. The consequences of that in terms of fiscal policy, the interest on the accumulated debt, that will start to become very significant at some point. So I think that there could be a conflict between fiscal and monetary policy down the road, where the fiscal authorities might be unhappy when the Fed ultimately has to raise short-term interest rates. But that's years off at this point, and I don't really see a big conflict at the current time. I mean, I think if anything, I think the Fed would like to see more fiscal policy stimulus right now. I think the Fed would like to see Congress come back with aid to state and local governments, probably some extension of unemployment compensation benefits, because I think they're worried about the very sharp fiscal contraction that we're going to see after July if there's nothing more forthcoming from Congress.
Thank you for that. In your challenges ahead, and maybe this is too future oriented, but you just alluded to it. Do you worry about Fed independence? Do you see fiscal dominance creating a problem down the road that could compromise the Federal Reserve as you know and love it?
Well, right now, I don't think there's really any, independence issue. I mean, yes, the Fed is working closely with the U.S. Treasury, but the goals are, aligned, and it's not controversial. I mean, Democrats and Republicans both support what the Fed is doing. So, at the end of the day, I mean, people can overstate the degree of independence that the Federal Reserve has. I mean, independence is not really about what goals the central bank should pursue. Those goals of full employment and price stability are set by Congress. The independence is really more about tactics, how the Fed goes about achieving those goals. So I think the first thing I'd say is that, the independence idea is a little bit overstated. But I do agree that, down the road, there could be a conflict between what's good for monetary policy and keeping inflation in check and what's good for fiscal policy. You look at what happened, after World War II, the Fed had put caps on long-term interest rates, and that started to generate some upward pressure on inflation. The Fed negotiated with the Treasury the end of the Treasury-Fed Accord in the early 1950s, but the Fed, was slow to respond to the inflation pressures that began to develop in the 1960s and early 1970s. So, I don't know if that was an independence of monetary policy issue or not, but you can certainly imagine that there was going to be a tension at some point potentially. Whenever you have a large accumulated overhang of debt, there's always pressure and incentives to inflate away the debt, and so I think that will arrive at some point down the road.
Well, I'm sure we're going to have a ton of monetary policy questions, so I'm going to ask you a little bit more about some of your remarks that you made about moral hazard, and you've written an article in Bloomberg and that was covered in the Washington Post as well. So the Fed, not only did the Fed have to go this time through the Bernanke playbook, but they had to go much farther this time, and you outlined some of that. And so I did have a question for you about financial stability. We always talk about the dual mandate, but the Fed also has financial stability responsibilities. So how do you feel about U.S. oversight of non-banks and market-based finance? So the Fed, the central banks of the world have done a good job with Basel III, I think, in strengthening the banking system. But the non-banks, market-based finance is more in the realm of the FSOC and the SEC. They've adopted an activities-based approach. They don't act as systemic and prudential regulators, the best I can see. And I frankly don't even know how they would implement an activities framework other than telling me that that's the way they do it. There's a huge leverage in the system in the US. There are proposals about equalizing treatment of debt and equity. There's proposals about gates and fees and all that. But the Fed has responsibility for financial stability. And you could easily have problems in the non-bank sector that cause problems for the economy and financial stability. And yet the Fed, it seems to me, is relatively quiet about this area. Certainly, they don't propose options on how to tackle the situation in the financial stability reports. I was wondering just how you see this. Does the Fed need to be more outspoken and activist on this front?
I think so. Because the reality is, as you say, the banking sector seems to be well regulated, a lot more capital, a lot more liquidity, very solid. The non-bank financial sector still seems to be underregulated from a financial stability perspective, and we see a number of cases where, that the non-bank sector was over its skis in March when the pandemic started to become, really a significant issue for markets. So the Fed had to intervene in the Treasury market to basically enable hedge funds to get out of highly leveraged trades where they were long cash treasuries and short futures. The Fed intervened to support the corporate debt markets to basically restore market functioning in those markets. And Fed intervened to support the mortgage-backed securities market because there was also quite a bit of stress there. The problem is that the Fed doesn't regulate the amount of leverage in those market segments. And there's also a problem that people basically invest in assets and they think they have overnight liquidity, but those assets, if they're highly illiquid, really can't really be managed to that kind of mandate. So look, I think there's a real issue for the non-bank financial sector of how we're going to actually regulate. What you don't want to have a situation is where people can do whatever they want, and then there's a problem, and then the Fed comes in and sort of bails them out, because that sends a message that, okay, the tail risk is really not, you don't have to absorb the tail risk. The Fed is absorbing the tail risk. The U.S. government is absorbing the tail risk. That encourages those entities to take more risk in the future. Now, I think if a financial crisis happened once every 50 years, this moral hazard problem wouldn't be very significant, because no one would remember the potential for bailouts. But when we have something like this happening, every 10 years or so, then I think it starts to become potentially systemic. People say, gee, the Fed's always going to ride to the rescue, therefore I can take more risk, therefore the Fed has to ride to the rescue next time, and then the situation becomes more and more acute. So I think this is something the Fed does need to talk about. And I think there's a number of things that could be done. I mean, for example, a very simple thing that could be done is basically tell people that if you invest in mutual funds that hold highly illiquid assets, you don't get overnight liquidity. You just don't. You get monthly liquidity. And if you don't want to hold the asset because you have monthly liquidity, you probably shouldn't be in that asset class to start with. So that's something that you could do very simply that I don't think would be greatly disadvantaged to investors. In fact, it might actually put investors on notice that the asset class that you're holding actually has some risk associated with it. Another thing I think they need to do is think about how can we make people pay for liquidity insurance ex ante during peacetime. So all those hedge funds that were levered 50, 60, 70 to 1, how do you make them sort of get some sort of liquidity insurance ex ante during peacetime so that they bear some of the cost of the leverage that they're taking on? So I think these are things that need to be explored, and I think the Fed will be talking about them as we go forward.
Well, good. I think that personally that the United States needs more and better macroprudential oversight. Last question then, since we know each other somewhat in the international context. You mentioned that the Fed had done the swaps and there was the repo facility as well. I remember eons ago, Greenspan used to say that they take the international context into account insofar as it impacts the optimal functioning of the U.S. economy. It seems as if in recent decades, the financial channel has become a much more prominent vehicle for impacts. I was wondering, based on your experience and history, the Fed there's no global lender of last resort, save the Fed, perhaps reluctantly. What do you think about the international mindedness of the Fed? Is it perfect, or does it need to be more so? How do you think about that issue?
I mean, I think the Fed certainly takes the international outlook into consideration, but at the end of the day, their mandate is about U.S. full employment, U.S. price stability, so that can only go so far. So when the Fed intervenes and basically offers these foreign exchange swap facilities that auction money in ECB and Switzerland and UK and Japan, et cetera, they're doing that not because they're trying to support the international economy, but because they're trying to support the U.S. economy, because those banking organizations have dollar-based assets that they need to fund in international financial markets. And if that funding mechanism breaks down, which it basically was breaking down in March, the Fed wants to ride to the rescue, not because it helps the international economy so much, but because it actually helps support the U.S. economy. Basically the Fed is basically essentially providing a backstop for the dollar, which is a reserve currency. And I think by providing that backstop, that probably reinforces the attractiveness of the dollar as a reserve currency, and that's probably in the U.S. interest.
Well, great. Let me turn to Tamer Beg for a comment and a question, and I'm going to see what's in the chat room.
Thanks, Mark. Bill Dudley, thank you very much. Mark had earlier sort of thought aloud in our email exchanges about the things that we could ask you. You covered like 99% of that during your intervention. So it's a little challenging, but I want to stay on that international aspect. And from the point that you made that, the Fed will do things, even at the international arena, that sort of serves the US full employment and price stability objective. Now, I'm sure you know that in the markets, there's a big narrative of the pivot of the dollar toward a weakening trend, something that would be very much in the interest of the Fed from an easing of financial conditions perspective. And of course, the swap facilities and even the FEMA facility helped that, because we saw a soaring of the dollar in the really bad days of the pandemic-related panic. And after that, as the liquidity conditions improved, the dollar also sort of weakened. Could the toolbox be expanded? The swap was popular, it's getting unwound. FEMA was a bit expensive. Could the Fed expand the swap facilities to a larger number of countries, to the ones actually who really need it, as opposed to Bank of Japan, which probably needed it temporarily for Japanese corporates, but it doesn't really need that. And secondly, along the same lines of sort of helping monetary conditions worldwide, and by extension helping the Fed, could the Fed expand asset purchase to buying investment-grade emerging market bonds? So that's one sort of question that, from a financial stability perspective, does it make sense to expand the choice of assets beyond the geography of the US? Second question is more of a crystal ball gazing one, which is when we look at the experience post the Spanish influenza pandemic, and I see a big divergence in economic performance of the UK versus the US. UK was obsessed with going back to the gold standard and focusing on austerity, and as a result, suffered tremendously. And the 1920s was basically a lost decade for the UK. US was all about globalization in those days, big exporter of textile and capital around the world. And of course, US had a fantastic 20s. So I guess my question for you is that the UK experience, does that tell us that going forward, more than financing, what we probably need is debt forgiveness? So those are my two questions.
Okay. So in terms of the swaps, it's very unlikely the Fed is going to be willing to expand the swap networks beyond what they've done. I mean, swaps are basically about, private banks financing dollar-denominated assets, not about countries that are suffering capital flight reversals out of their countries and therefore having balance of payments problems. The Fed basically doesn't view that as in their remit. So the swaps programs have typically been confined to large countries that are highly creditworthy and major financial centers, and the Fed has been very reluctant to go beyond that. So, for example, recently the Turkey has been asking the U.S. for a foreign exchange swap program, and the U.S. has declined, and that just is an example of where that bright line is. In terms of emerging market debt purchases, I think that's highly unlikely. I mean, the Fed, in principle, is allowed to buy foreign sovereign debt, but they never have done that because it just raises this whole question of, like, why are you buying that country's debt versus some other country's debt? And it also could be seen as a device to deliberately, try to weaken the U.S. dollar. So the Fed has the authority, but they've never done it. To buy emerging market debt, the Fed, if it's non-governmental debt, the Fed would have to do it under Section 13.3. I don't understand how they could possibly, justify it under Section 13.3. That's basically a provision of the Federal Reserve Act that says that if borrower can't obtain credit under unusual exigent circumstances and with agreement of the U.S. Treasury, the Fed can basically come in and provide support. And I just don't see how emerging market debt would qualify under the provisions of Section 13.3. So I think that's highly unlikely. So I think the swap programs are basically going to continue as they are right now. They'll have the auctions in place, weekly auctions in place, and they'll be used to the extent that there's market strain. And if there's not market strain, the outstanding balances will be paid down. And what we see right now is they're being, as the 84-day maturities are starting to mature, we're seeing those outstanding balances are being paid down. In terms of the debt forgiveness issue, I think there's a huge issue in terms of emerging market debt that we are going to see over the next 6 months, caused by capital flow reversals and just the huge downshift in terms of global economic activity and the downward pressure on commodity prices. So I think there's going to be a very tough environment for emerging market economies, and that's going to create a lot of strain. But the Fed is, that's not in the Fed's purview. That's really something that Congress, the administration, the IMF, the World Bank, have to take up. I think that debt forgiveness may be an issue that's going to be on the table. It's also really important to bring the Chinese government along. China has a lot of debt of its own outstanding to emerging market economies. So there needs to be sort of a coordinated solution. I think it's probably needed, but whether it's actually going to be forthcoming in a timely way, I think that remains, in my mind, very highly uncertain.
Well, thank you for that. As you know, the IMF and the World Bank have put forward this debt suspension initiative, but I think the Chinese participation in that is mired in opacity at this point. Bill, you're getting lots of questions. Several questions relate to yield curve control. One questioner putting it in terms of what could be conditions that push yield curve control beyond enhanced forward guidance and acts more forcefully to lower long-term yields. And another version of that question is, would the Fed have if they're going to focus on the shorter term, does that imply a tolerance for a steepening at the longer end of the curve?
So let me take the second one first. So I mean, if you're not willing to, put a peg in place out to say 10 years or so, and you're only willing to go out, say 2 or 3 years in terms of yield curve control, then yeah, clearly there'll be, probably a steeper yield curve as a consequence. Obviously, depending on where you peg those shorter term rates. I mean, if you peg those rates at rates where they are today, probably doesn't have much effect on the yield curve. You try to peg those rates at rates lower than where they are today, then you're gonna end up steepening the curve. I would guess that currently rates out to 3 years are extraordinarily low, and so I would guess that the Fed were to implement yield curve control right now, they wouldn't be selecting yields significantly different than the yields you have in the marketplace today, and so I don't think it would actually lead to much steepening of the curve. The other way it could lead to steepening of the curve if people thought the policy was inappropriate. If you thought that the Fed was pegging rates too low for too long and that was going to lead to an inflation problem, well then of course the yield curve would steepen in that scenario. But as I said at the beginning, I don't think there's a real conflict right now between what the Fed thinks it's going to do and what markets thinks the Fed's going to do. Both think the Fed's not going to do anything for quite some time, for several years at a minimum.
There seems to be a perennial debate out there about inflation in the future. Getting a question on that. Do you have any thoughts?
Well, look, I don't think inflation is necessarily dead. I mean, obviously, the near-term impact of the pandemic is highly deflationary, right? Because you've had downward declines in commodity prices, you have excess capacity in large sectors of the economy. All that's deflationary. But medium term, there's a lot of things that would cause you to think that maybe there's actually going to be more inflation, because to the extent that you're destroying and damaging global supply chains, the extent that you're bringing activity back to the U.S. from abroad, that's probably going to increase your cost of production. It's probably going to reduce productivity growth in the United States. All those things, medium to longer term, could actually have an inflation consequence. But in the near term, inflation is really about pressure on resources. So until you get to a high rate of resource utilization, that's probably going to be the dominant influence. So I guess my view on inflation is it's not going to be a problem for several years. But looking at 3, 4, 5 years from now, I could definitely see inflation coming back. And so I guess where I would differ from the market view is I don't think that, inflation, the forward inflation curve should be flat going out, 5 to 10 years. I think it should be pretty flat out, 2, 3, 4 years. But after that, I think I would expect inflation should go back to, towards the 2%, the Fed's 2% objective, and probably even a little bit above it, because the Fed has made it, I think, pretty clear that they want to hit 2% inflation now on average. And so if you're going to hit 2% inflation on average after years of being below 2%, that means you have to tolerate a little bit of inflation above 2%. So I would actually expect that inflation, 5 years from now, if I had to pick a number, I'd probably pick something like 2.5%.
Thank you. Do you think there will be any loans through the Main Street lending facility? Is there a constraint on lending to credit-worthy borrowers? Won't this be plagued by adverse selection, especially given that the price is LIBOR plus 300 basis points?
Well, I think the Main Street lending program is a difficult program for it to work, well, because the risk is that, let's imagine if you're a bank and you have a person that needs the money and you think is actually a good credit. Why would you participate 95% of the loan out to the Fed? You basically say, this is a good credit, I'll lend them the money. The type of person that I can imagine a bank making a loan to is a borrower where the bank already has a lot of money outstanding to the borrower. The borrower is in a great deal of difficulty, and getting 95 cents on the dollar from the Fed will allow that borrower to pay the existing loan for several years, and will give the some chance for the company to recover. So I think there is a very I think definite risk of adverse selection, that the Fed gets all the loans that are quite questionable, and the good loans the banks basically keep for themselves. So we'll see how it works out in practice. It's also hard just to create a program like this, one size fits all. I mean, the terms and conditions are basically the same regardless of the industry that you're in. I mean, if you look at your leverage ratio in 2019, if you're a grocery store, that leverage ratio probably doesn't have any great constraint on your viability this year, right? Because grocery stores are doing fine. If you're a restaurant, that probably doesn't matter what your leverage ratio was in 2019. You're probably in a great deal of difficulty today. So the one size fits all also, I think, is a problem. I mean, one of the fundamental issues with the Main Street lending facility is that if you think about what the program is designed to do, it's basically the Fed is basically providing balance sheet to the banking sector. The whole idea of having banks participate their loans out to the Fed is the notion that the banks themselves don't have enough balance sheet capacity to take these loans on their books. That's possibly, maybe that's true, but if the theory of the case isn't right, if it turns out that there isn't a bank balance sheet constraint, then the program's not going to work very well. So we'll see how it goes. I mean, I think the Fed is trying to do the right thing in terms of supporting businesses that essentially weren't supported by the corporate bond buying facility because they're too small, and weren't being supported much by the Paycheck Protection Program because they were too large. There was a bunch of companies that sort of fell in the middle, and the Fed and the Treasury are trying to come up with a program that supported that group of companies. But we'll see how well it works in practice. It's off to a slow start. I mean, complex program, hard to stand up, hard to operationalize. So it takes a while for the Fed to get these new operations underway.
You would know that better than most. Any thoughts for us on the Fed's decision to put a hold on dividends at their current pace and to eliminate buybacks for now? Should this be continued or not? You can weigh in on Lael's dissent, and how worried are you about losses in the banking system?
Well, I think the banking system is, in good shape going into this. It's just a question of how bad is the economy, and that's really what's going to determine how many credit losses there are. And I think the Fed, rightly understands that there's a tremendous amount of uncertainty about how this is all going to play out. So I certainly think that the Fed's decision is completely understandable. It's not like the capital disappeared. I mean, this is the thing that always makes me, frustrates me a little bit about this whole issue about putting restraints on bank dividends. Well, the restraints on bank dividends are not permanent. They're just temporary. They're temporary as you are going through this period of tremendous uncertainty about how the economic outlook is going to unfold. If it turns out the economic outlook turns out to be more benign than expected, this capital will ultimately be returned to the shareholders. It may be returned a little bit later, but it will be returned to the shareholders. So I think it's really important to recognize that the implications of this for banks and bank investors is actually pretty mild. I mean, you think about it, conversely, let's imagine that the environment turns out to be really bad and the banks had paid out the dividends and then they had to go out and raise capital in a very adverse environment. That cost of capital at that time would be quite high. And so I think that would actually be, if I were a shareholder, I would actually prefer the bank to hold back a little bit of dividends so they don't have to raise more capital in an adverse scenario. I think that would actually be, I actually think it's potentially in the interest of the shareholders, even if they would prefer to get their dividend money today. So I think whenever you have an environment of a high level of uncertainty, I think it's prudent to be cautious about capital distributions because you don't want to distribute the capital and then go, oh, we shouldn't have done that. And right now, you just don't know how severe the stress on the banking system is going to be. So it seems to be prudent in the current environment to just, hold back a little bit.
So the IMF said last week in its update, its kind of mini global financial stability report, that there's a disconnect between markets and fundamentals. Mr. Natolucci, a former colleague of yours, wrote that. Any thoughts?
Well, yes and no. I mean, the Fed has basically come forward to be the buyer of last resort for a pretty broad set of financial markets, and that's reassured financial markets, and that's understandable, right? The risk of a huge illiquidity event in the corporate bond market and municipal bond market, treasuries or agency mortgage-backed securities in the United States has been significantly reduced because the Fed stands behind those markets. So I think that's provides a lot of support for those markets. I think where people are scratching their head a little bit more is the U.S. stock market. Why is the U.S. stock market recovered probably 80% of its earlier decline in light of what's still a pretty difficult environment? And I think the issue there is really a question of valuation. When bond yields are extraordinarily low, when 10-year Treasury note yields are below 1%, then that provides a lot of support for the U.S. equity market. I mean, if you look at the equity risk premium in the U.S., you take the price earnings ratio of the U.S. stock market, and you take the reciprocal of that. So let's call it 20 times right now for the sake of argument. So that's 5%, and you compare that to the real yield on Treasuries, which is essentially zero. That 5% equity risk premium is actually not particularly depressed. So I think the equity market's a tougher animal to sort out because it's hard to if you value the market on historical PE ratio, you'd say it's excessive. But if you value it relative to the level of real bond yields, then it doesn't look so overextended.
What if the Fed doesn't ever get to its 2% target? Is there a need to reassess 2%?
Well, I think that the Fed wants to get to its 2% target, and it's going to keep policy accommodative until it does get to its 2% target. And I think someday it will achieve its 2% target, just not right away. The reason why you want to have a 2% target, as you know, is that it gives you a little bit more room on the peak of the cycle in terms of getting short-term rates up to hopefully 3%, 4%, 5%. So you actually have some room to cut interest rates when you fall into the next economic downturn. Now, we saw in this current cycle that didn't really pan out. The Fed never got short-term interest rates up very much, both because real yields are very low, but also because they never got inflation back above 2%. So the Fed didn't have a lot of ammunition in terms of cutting short-term rates to stimulate the economy when we were hit with the pandemic. So I think the Fed's going to keep, 2%. There's been some talk about actually moving to even a higher inflation target. I think that's highly unlikely. The Fed basically gets its instructions from the U.S. Congress. The U.S. Congress has said price stability. The Fed has interpreted price stability as 2% inflation. That's probably taking a little bit of liberty to move beyond, to a higher number than 2%. I think that's very hard to square that with price stability. And it's taken a long time for the Fed to get inflation expectations anchored, close to 2%. So if you were to move away from 2% as your inflation objective, I think you'd be giving up a lot of hard-earned gains. And finally, if the Fed were now to move away from a 2% inflation objective, people wouldn't view it as credible. People would be like, well, that's nice that you now have a 3% or 4% inflation target, but you couldn't even achieve 2%. So even if you decided that you wanted to move to a higher inflation objective down the road, you certainly wouldn't be doing it at this point because it wouldn't be credible.
You spoke a bit about inequality in your opening remarks. The Fed is doing what it can to support the recovery, good financial conditions and whatnot. So is there any contradiction between supporting the recovery and fighting inequality, and how far should the Fed go in thinking about this?
Well, the problem I think the Fed has is that their toolkit is limited. I mean, if the Fed could somehow pursue a monetary policy that supported the economy and also reduced inequality, they definitely would do that. But they don't have a toolkit that really is designed to reduce inequality, except by getting people employed. To the extent that the Fed can stimulate the economy and get the unemployment rate down, that helps less advantaged people, and that's basically the Fed's goal in terms of supporting economic activity. Making financial conditions more accommodative does support people who are wealthier, but the goal here is not to support people who are wealthier. The goal here is ultimately to support the economy, and so the Fed needs to be clear about what they can and cannot accomplish, what tools they have to achieve their objectives, and why they're using the tools that they're using, and how those tools ultimately can benefit the average American.
A question on forward guidance: how subject to misinterpretation is it? The questioner says that Mark Carney was called an unreliable boyfriend. If you don't give a market what it wants, is there something wrong with that?
Well, forward guidance is, there's these two forms of forward guidance. One is Delphic, where you basically say, this is what we think we're going to do, but we'll do whatever we think is appropriate in the longer term. In other words, the current FOMC can't constrain a future FOMC of doing something different than what the current FOMC said it would do, 2 or 3 years out in the future. That's Delphic forward guidance. There's also Odyssean forward guidance, where basically you say, we're going to do this even if 2 years down the road we wish we hadn't committed to do this. In other words, we're binding ourselves to the mass so that we can basically not be seduced by the sirens. That kind of forward guidance really, the Fed really doesn't actually have the ability to do that, because no current FOMC can actually bind a future FOMC. But to the extent that the Fed does initiate Delphic forward guidance, it does make it a little bit harder for the future FOMC to sort of go against it. So it's, so there's probably a degree, in between Delphic and Odyssean where the Fed can probably end up, even if it can't get to Odyssean forward guidance, where it basically says we're doing this, and even if it turns out that it's the wrong thing, we're gonna stay the course. The Fed can't really do that.
So I remember Chairman Powell gave a speech at Jackson Hole a while ago about navigating by the stars and how difficult it was. I've had some observers tell me that they're big fans of Jay Powell because he pays less attention to the stars and seems very focused on doing all that he can to get unemployment as far down as possible. How do you think about the stars these days, and our star in particular?
I've never been that big a fan of the stars, because the R star, U star, they're all unobservable variables. Potential GDP is another GDP star. They're all unobservable variables, so that they're useful from a heuristic device of explaining why the Fed's doing what they're doing. So, for example, when the Fed began the last economic expansion and short-term rates were zero, and the Fed, R star was a way of explaining why the Fed was ultimately going to be forced to raise short-term rates, because they had to bring real interest rates back to R star. So it was a good heuristic device to explain why the Fed was doing what it's doing. But end of the day, I'm not a big fan of the stars. And I think where Chairman Powell comes out, it's pretty close to where I come out. Also not a big fan of the stars, because at the end of the day, monetary policy works not through R star, but through financial conditions. At the end of the day, it's really how the Fed pulls the monetary policy lever and how that affects financial conditions that matters in terms of how the monetary policy impulse gets transmitted to the real economy. And so, R star isn't probably an immutable, constant number. The stock market goes up and the dollar goes down, R star probably climbs. And if the reverse happens, R star moves up. And so this idea that R star is this immutable number that the Fed Reserve has to hit probably doesn't really conform to how I or how Chairman Powell think about the transmission of monetary policy to the real economy.
Thank you. If listeners have more questions, please throw them in. There have been some debates about stress testing in the last week. You can tell us what they are, but any thoughts?
I think this, stress testing of the banks, it's been a very good thing, because it basically puts capital regulation on a more forward-looking basis. So it's not just did you have enough capital to get to this point. It's do you have enough capital to get through a stressful period in the future? And so I think the advantage of the stress tests is that they basically put the capital requirements on a more forward-looking basis. If you remember back to the financial crisis, I mean, to me, the turning point of the financial crisis was really with the stress test, the so-called SCAP that was implemented in the spring of 2009. If you remember, the Fed basically put the banks through significant stress, and the idea was that the banks were going to either have to raise capital to fill any hole they had, or the TARP money would be mobilized to provide capital to those banks. And those stress test results were released, and they were viewed by market participants as highly credible. The capital went in, either the banks raised the capital or they got the capital from TARP. And all of a sudden, the banking system in the United States was viewed as viable again. So I think that stress testing, I think, is a hugely important way of retaining confidence in the integrity of the banking system, and having confidence in the integrity of the banking system. I think is hugely important for household and business confidence and having a sustainable economic recovery. So I'm a big supporter of stress testing.
A few people were asking, since the Fed is buying up tons of things, why not stocks? Why not gold? Any thoughts?
Well, it all comes down to 13.3, which is the special authority for the Fed to engage in these interventions. There's nothing. The Federal Reserve Act basically says the Fed in normal times can only buy treasuries, agency mortgage-backed securities, foreign sovereigns, which they've never done, and short-dated general obligation securities of less than 6 months. That's it. And besides that, they can do things under 13.3. But 13.3 basically is you have to find that this is important for the U.S. economy, that the borrower can't get credit by any other means, and it's about credit. It's not about equity finance. So I'm not really sure if the Fed could even stretch so far as to do a 13.3 equity facility. Now, in principle, the way these facilities are set up, the Fed sets up a SIV, lends money to the SIV, and the SIV buys the assets. So in principle, perhaps the SIV could buy any kind of asset, but I think I would think that would be challenged as being going beyond what's authorized under 13.3. I think that'd be really a stretch to see that as legitimate under the Fed's 13.3 lending authority.
If Biden were to win, any changes at the Fed?
Not necessarily. I mean, we've certainly seen, administrations name people of the different party. So, Greenspan was reappointed by Clinton, and Bernanke was reappointed by Obama. I view Jay as, a highly capable guy. He's doing a good job, and I could very well see him be reappointed by if there's a Biden administration. I mean, it's not for sure. Obviously they have their discretion, but if someone's viewed as doing a good job, it's not obvious why you want to change horses in midstream.
A lot of things aren't obvious in Washington, but in any case, will the Fed extend the 13.3 programs after September?
Obviously, it will depend on how things are going, but I think prudently, I would be surprised if they don't extend the programs. It seems to me that the pandemic has certainly not run its course. We don't have a vaccine. We don't have a vaccine that we can distribute. So you got to believe that the pandemic is going to be, a pretty important reality for the U.S. economy and U.S. financial system for, at least another, at a minimum, another 6 months, and probably more likely, 12 months. So I'd be really, really surprised if the Fed didn't extend the 13.3 facilities. I mean, Fed has no problem if the facilities are there and just serving as backstops and aren't used. Fed does not judge the success of the facility by how much it's used. If the facility can actually bring down credit spreads and without the Fed actually buying many assets, that's a perfectly successful facility. So I'd be very surprised if they don't extend the duration of these 13.3 facilities.
All right. Well, we're winding down, so I'm going to ask you a last question. Look, you were absolutely central in the global financial crisis, 08, 09, designing facilities overnight. You were in a hot seat. Is there anything from that experience that that hasn't been adopted this time around, or any major thoughts you have about the contrast between the last crisis and this crisis?
Well, I think the big contrast is that the enemy here is the virus, and the enemy the last time was a lot of bad actors in the U.S. financial system. So there's a lot more support for what the Fed is doing than last time, right? Where the Fed actually had to come and rescue large institutions that got into difficulty, not because they wanted to rescue those institutions, but because the collapse of those institutions would have really harmed the U.S. economy. So I think there's a lot broader support for what the Fed's doing this time. Also, the Fed, had a lot of things on the shelf that they could pull off the shelf very quickly, and so that made it a lot easier for the Fed to proceed aggressively. So I think it's been easier for the Fed this time. They've had, they had things on the shelf. They have a lot broader support. So I think it's been a lot easier for the Fed. I think the one thing I would just say for the Fed, though, they need to communicate. They just need to keep explaining why they're doing what they're doing. I think last time the Fed, I think, basically did do the right thing, but the Fed did not communicate very well about why it was doing what it was doing. And so, to me, the lesson from the great financial crisis is you can never communicate too little to not just to financial markets, but also to American households and businesses. And so I think it's a really important. I think the fact that Jay does a press conference every meeting helps, but I think it's really important to explain yourself in layperson's terms about why you're doing what you're doing and how you think that will help.
Well, thank you for that. We will wind this down. I just would say that the reason the Fed had so much on the shelf and owes very much to your successful tenure and reign at the New York Fed, both on the desk and as president. We thank you for all of your service. I thank you for joining us today for a fantastic presentation. Thank you, Bill Dudley.
Thank you, Mark.